Hey everybody, today we are talking predictions 2025 and we're going to dive into the rental market and rents and what we're expecting this year.
It's going to be an interesting year for all of us, and I know a lot of you guys want to hear what we're doing. We're actually having a whole prediction webinar tomorrow, but for today we're going to talk to you a little bit about what we're going to discuss tomorrow.
Yeah, we're going to start with the rental market.
All right.
So let's talk about the rental market. So everyone can see that most of the country has some softening of rents currently. And so I think a lot of people think that's going to continue into next year. So the first thing is less new units are going to come to market next year than they did in 2024. So it's going to be about 20% less.
Yeah, and I think it's important that everybody understands there's a lag. So what that means is when you break ground on let's say you put a shovel in the dirt, it could be a year and a half before you actually even open the clubhouse. And then from there, you could have a year and a half, 2 years of what's called a lease up, even longer depending on the size. So there's a lag. Same thing with single family homes. There's always a lag, obviously, to build a home, to build a multifamily property. So what we're seeing, and when we're talking about units on the market, let's say in 2024, those are units that broke ground, and it could have been in 2021, 2022. It significantly dropped off in 23 because of interest rates went up so much. So that's what we're talking about. These are actual units that are hitting the market. And I think that's important to understand because what that does, new supply offsets everything. It's good for the renter because now the renter has more choices. It creates softness in the market. And then those units need to be absorbed. And so that's what's actually happening now.
Yeah, and to be fair, we've had so many rentals come to the market this year that a 20% decrease is still a decent amount in some areas.
It is. Yeah, it definitely is. And it's also important to understand that there are certain areas that are being built and there are certain areas that are not. And so typically you have concentrations of construction in areas that developers might think are vibrant. And then you might have areas where nobody's building anything. Mm-hmm. And so, when we're talking about units being delivered across the United States or across even a state or a city, it doesn't necessarily mean that your area might be, really, really strong or really weak. What it means is that that's obviously a national figure, a state figure, a city figure. So you need to drill down even more. But the point is actually that these units are being delivered. They are hitting the market. They are absorbing. They're new. So renters like new. A lot of people like new. And then once they get absorbed, then we'll see a drop off because after they get absorbed, what it really affects some of the older product.
And so that brings us to our second prediction, and that's that rents are going to stabilize this year.
Yeah.
That doesn't mean they're going to go up necessarily. Some areas they will, but they're going to stabilize.
Yeah, and stabilization, again, in some areas they've actually gone backwards. So what happens if you take a look at areas like, let's say, Austin, Texas, or Nashville, you're going to see that units were already delivered there. Like when I went, there were like 8 or 9 cranes in the air in Nashville, right? They're building everywhere. That's good for the consumer, not necessarily good for the investor, the owner, the bank. Now, those are moving through. People are absorbing. People are still moving to Nashville. They're still moving to Austin. And so that will get absorbed. In those areas, you're going to see negative rent growth. You're going to see concessions. You're going to see things like that. But then there's other areas where you're going to see more stability. And again, if the consumer wants to win here, it's going to be through supply. And that's what you're starting to see here. But we are definitely going to see a stabilization of rents. If you're buying right now for 2025, one of the predictions you should not make is significant rent growth. Right. That is a fact. So you need to basically underwrite it at flat, potential potentially even concession-based, unless you're a unique market where there's been no delivery of units at all, and there's a lot of people moving there, and and you're highly occupied, and you might still see some rent. We are actually seeing some rent growth in some areas, but generally, Danille's right. Rents nationally are going to stabilize.
And Jerry, can you pull up that chart for us too?
Yeah, I think this is a good chart to tell you.
Yeah, so, you're kind of seeing the South is having a lot of rent decreases. Florida's having a significant rent decreases. Nashville's having significant rent decreases. And then, you have the Midwest, and you have a lot of increasing rents in the Midwest.
Yeah. So before you move off of this chart, the reason why, so if you take the 10 cities with the fastest rent growth and the 10 cities with the fastest rent declines, you're going to have a net negative, or stabilization, I should say, right? So when you're looking at markets, it's important to understand these are just 20 markets here. We internally we look at like 60. And there's other factors here as well, but this is a really interesting barometer for you guys, especially if you're buying in Texas, for example. Those are, a lot of people are really looking at Texas. We already knew about Florida. Florida's, the bloom's been off the rose in Florida for a while. But some of these other markets, in fact, what's interesting is that Midwest, kind of where you're from, Danille, is actually projected to be really, really good. And there's a couple reasons that's not reflected here. The biggest one, and specifically in the center of the country, it has to do mostly with affordability.
Right.
So that's what the Midwest brings for a lot of people is affordability. So if people have the flexibility to move there and live quite differently and live a little bit different lifestyle, they can significantly adjust the needle for them by moving to some of the Midwest. And I've invested in some friends of mine, property in Columbus, a multifamily deal in Columbus, Ohio, for this exact reason, because they have not seen negative rent growth there, and there's a lot of people moving there.
Well, and what's interesting too is, rent growth in the Midwest, like Cincinnati has had one of the highest rent growths in the country. You also have to remember the rents are cheaper there. So, a significant rent growth does not necessarily reflect the dollars in rent amounts.
Yeah. What is interesting though, if you look at nationally, and I think this is important, multifamily rents nationally right now are around $1,700, and single family is right around $2,100. No, I think it was $2,107 or something. So single family rents are obviously higher than multifamily rents, and so this is just rents. It doesn't actually break it out. But what's really interesting to understand is that even in markets like Cincinnati or Columbus, or let's just say Ohio in general, which is where Danille grew up, the rents actually have moved quite a bit over the last 10 years.
Yeah.
Because it's recognized as a really great market. It's affordable. A lot of people are moving to the Midwest just because, again, they want to upgrade their lifestyle, especially, and I know we're going to talk about this, but the work from home and all the other things that can come with having the flexibility to be able to move where you want. But we are seeing that inflation's a bummer for a lot of folks, and they can make some choices.
Yeah, and Jerry, if you want to pull that chart back up, the one thing that was a little confusing to me is that they were saying, fastest rent growth was San Jose and Sacramento, because I know San Francisco is having significant rental decline. So I would be interested if people are moving out and moving there.
So this is exactly it, because I actually did a deep dive on this. Mm-hmm. What's happening is people are obviously not happy with San Francisco, right? And so they're moving out of the city, but they're not necessarily moving out of California. Mm-hmm. And so these are areas that are booming. So what you're seeing is a lot of the suburbs. People are moving just outside of the cities. They're doing the same thing where I grew up in Seattle. As you can see, we're seeing booms in markets just 30 minutes south and north of Seattle, as an example. And so as people decide that they don't want to live in crime areas, let's say, because that's actually one of the biggest things going on there right now, they're relocating, but they're not actually leaving the state.
And before we dive any further into this, we did want to let you know that we're going to be doing a webinar tomorrow to go through all of our predictions. So if you want to go there, go to investwithmc.com. Is it investwithmc.com? Investwithmc.com/Ken 2025. Make sure the K in Ken is capitalized, or you can just click on the link in the description.
Yeah, keep that up for a second, Jerry, would you? So for you guys interested, Danille and I made a list of things, and obviously you guys probably know that we do a lot of research, and we're buying a fair amount of stuff next year. So we're going to talk about markets that we like. We're going to talk about mortgage rates. There's a whole bunch of stuff around Trump that needs to be addressed around housing and immigration, and then of course inflation. But one of the biggest things that we're going to discuss that no one's talking about is the total cost of ownership. And that's going to be a big deal. Most people equated buying to mortgage and principal or principal and interest. But now there's the total cost of ownership, which is tax, insurance, maintenance, even HOA fees. So you guys are going to want to make sure that you watch this tomorrow, because we're gonna do a deep dive on a lot of these little markets.
Yep. Join us live tomorrow. All right. So let's keep going here. So the next thing that we are going to see, and another reason we think rents are going to stabilize, is the cost of purchasing a home is exceeding the cost of renting by about 40% nationwide right now, which is significant. And that's kind of what we touched on a second ago, between insurance cost and property taxes and all the different things. It really, maintenance, it really adds up.
Well, as a renter, that's the landlord's expense. So now those are real things. The insurance industry is going through a flux, I should say. Our insurance rates went up over 30%, and then it went up again. And that was 1 year ago. And certainly our property taxes are coming. We're already appealing those, and we're getting clobbered there. So as you guys know, property taxes pay for a lot of local budget stuff. And now that people are moving out of the cities, let's say Seattle or San Francisco, for example, or Portland, those cities still need money to run. And so what do? They're starting to increase some of the property taxes to be able to pay for some of that infrastructure. And I'm talking about, all the basic stuff, not only just schools, but the fire departments and the police and all that kind of stuff. So you're going to start to see more and more of that. And of course, for those of you who already own, you probably are seeing your HOA fees have gone up a lot, right?
Yep, absolutely. That's just another expense. And you have to remember, too, that there was 1.5 million new households created last year. And pre-pandemic, it was closer to 900,000 per year. So it has not quite doubled, but it's significantly more.
Yeah, I agree with that. And the other thing that I just wanted to point out that a lot of people may or may not know, as of this year, as of last quarter, 86% of all the homeowners in the United States had below a 6% mortgage. So let me say that again. 86% of all homeowners in the United States had below a 6% mortgage. And as you guys know, mortgages right now are over 6%. So, and of course, there's a wild card. We're going to talk about that tomorrow on the webinar on where we think that's heading. What's really interesting is just 2 years ago, that was 93%. So guess what that 7% equals? Because there's 230 million homeowners. So 7% equals 15 million people. So I found it interesting that up to 15 million people actually got out of those mortgages in the last 2 years. And I think that's important to realize. And so I was digging a little bit deeper on this topic, and they call it the 3 Ds. One's death, the other's divorce, and the other's debt. So death, divorce, and debt. Those are the 3 Ds that people are talking about. So now, obviously, they're categorizing everybody into those, and not everyone is in that. But it is interesting when when you have a mortgage, let's say at 4 or 5%, and you know mortgages are 6 to 7%, that you're actually selling to get the equity. And so there's a fair amount of that, and so now whether we haven't tracked yet whether they bought new houses or they started to rent, but this is precisely what we were talking about in that trapped equity discussion that we had, and we'll go into a little bit about this next tomorrow. Jeez.
The other thing that we want to talk about is Airbnbs. You know, while we're on the topic of rents, we can't not talk about long-term rentals.
Yeah.
So those aren't doing very well right now, mainly because so much supply has come to the market, partially because, you know, people aren't traveling as much and staying in them. People are kind of starting to migrate back to hotels in a lot of markets, especially your smaller ones, because of all the different fees. So hotels are doing better than they were pre-pandemic.
And regulations.
And regulations as well.
Yeah, the cities and counties hate them.
So, and we had always told you guys, if you would have listened, don't buy an Airbnb unless it also works as a long-term rental. And in the last few years, they typically hadn't worked as a long-term rental. They only worked as an Airbnb. So what we're seeing now is people trying to convert their Airbnbs to long-term rentals to try to break even. And when Ken and I were looking, you know, it seems to be there's a max, like a ceiling on single-family long-term home rentals.
I think so. Yeah, and then also you have personal experience on this exact issue with the home with an Airbnb. Danille did a really, really smart thing. She subleased for 1 year, 12 months, no vacancy, to an Airbnb person that wanted to use her place as an Airbnb. So Danille got her rent every single month. And of course, the arbitrage is that the Airbnb company had to make more than that to make money. And after a year, they shut it down, right?
Yeah, it just really, I mean, I think maybe he made a little bit of money on it, maybe, but it really definitely wasn't worth the work, the additional work that it would be. But what we're seeing, you know, we're seeing a lot of people putting their Airbnbs up for sale. And I was kind of interested in, you know, what like a 4-bedroom home would rent for in Scottsdale, because I have 2-bedroom homes and they rent for right around $2,750, $2,800 currently. And what I was finding is there's really a ceiling on a
rent.
single family home, what you can charge for rent, and it's about $3,500, maybe $4,000
at the moment.
At the most,
and that's in this market.
And in this market, right? So if you have, and I'm not talking about a luxury house, I'm talking about your average 4-bedroom single family home. From what I've seen on, you know, Zillow, it doesn't matter if it's 4 bedrooms, 5 bedrooms, it's right around $3,500, $4,000. Because, you know, think about it. If you're willing to pay more than that, you might be able to afford to buy.
Yeah, I think that really boils down to how much does the consumer really want to pay in rent. Right.
Yeah.
And what are they making, and what, you know, so obviously if you have a family and you're budgeting, I'm sure, and you're trying to figure, you're not going to want to pay $6,000, $7,000, $8,000 in rent. And the issue the Airbnb has is those are the kinds of numbers that they need in order for an Airbnb to work. In fact, you looked at an Airbnb the other day that needed over $10,000 a month.
Right, correct. And it's not going to support that. And some of you are commenting, you know, in certain markets it's more, it might be, you know, 6,000, it might be, you know, every market's different, but there is a cap. So it's not, you have to look at that when you're buying, right? Like for a 2-bedroom versus a 3-bedroom versus a 4-bedroom, when does it not make any sense to have more bedrooms? Like because for what's certain is the price of a house goes up with every bedroom, and it does support that more, right. The price of a home.
If you're commenting from LA, you're laughing at us, right?
Yeah,
you know,
right,
because
yeah.
We get that, right?
Yeah.
There are certain markets that, you know, these are just ridiculously low.
But I do challenge you though to look at your market before you're like, ooh, I want to buy this 5-bedroom house, or I want to buy this 4-bedroom house, or, you know, kind of look at that, because your ROI might be better on a 2 or 3-bedroom house depending on what your rental cap is.
Well, I think the proof is in the pudding. Danille's been focusing on, which are hard to find, 2-bedroom homes with 2-car garages and a yard, and those are out there. They've been built, and so she focused on that. Obviously, it's one of the lower priced homes in Scottsdale, and her rent is almost darn near $3,000 a month. If you jump up to a 4-bedroom, it's only $500 to $750 more a month.
Yeah.
For a 4-bedroom. So
Yep.
the incremental value of buying a 4-bedroom isn't actually worth it. In her case, it's better to buy that affordable one.
Exactly. And what you need to understand and remember is people will make it work. Like in, one of mine, I have 3 people, a woman with 2 children living there, and the 2 kids just share a room, So, it just keeps it affordable for everybody. So, but there is that ceiling. So that's one of the things that we found interesting. So another prediction we have is that home prices are going to stay high next year, which is controversial because a lot of people think they're going to fall.
Yeah. Well, if you take a look at National Association of Realtors, NAR, Redfin, Zillow, any of the folks that are tracking this, they all think they're going up. Now, obviously, some of those probably have to say that, but what's going to make homes prices go down is more homes. And right now, because I looked right before this discussion, we're just at 3.1 months supply. That's all we have right now. And now we were in the 2s, of course, so it's gone up, but it's far from average. Mm-hmm. And so again, just going back to basic supply and demand, what's going to bring a price down is supply being added to the market. Now that can be in the form of new construction, or it can be in the form of listings. So when you as a consumer have lots of choices to be able to buy something in a neighborhood, you have negotiation. If one comes on the market and there's a bunch of offers on it that hasn't been on the market for a while, then of course the price is going to be high. It's that. So this is a supply and demand thing, and it sure doesn't look like, even though we're starting to see that supply being hit right now, that's actually making something soft on the multifamily side, but not like we're seeing we're not seeing it on the single family side.
Yep. And another prediction we have is that renters are going to be moving less.
Yeah.
And that's why, we're really big with you guys on trying to keep your tenants, because this is the kind of market you want to keep your tenants and you don't want them to go anywhere. And the reason that they're going to stay is because there's not big rent increases for them to move.
Right. I mean, before you guys could generally predict a 5, 6, 7, 8% rent growth, and then capture them again on a lease. Somebody else coming in right behind them. And minimal vacancy. Now it's a little bit different. Now you've got the potential risk of higher vacancy, and also as other people are fighting for tenants. As the market stabilizes, the tenants have more options, mm-hmm. And so as the prudent landlords are actually probably trying to renew a lot of their tenants right now. If I were in your shoes, and I would do that. On the tenant side, it's also a good time for you to look around. And see what kind of deals are out there, and have that information when you're renewing with your landlord as well. So either way, this is the year for the tenant in 2025.
Yeah, it's funny because one of my friends right before this just texted me and asked me if her building's trying to raise rents on her. She's like, what's a normal rent rate? Because she's considering moving because they want to raise the rent right now.
And to her point, that's when people start looking, right? Mm-hmm. Like if you're paying whatever and your life is feeling the inflation like everyone with the food costs and the gas costs and the insurance on your auto, let's say, are up, and your renter's insurance is up, and everything's up. That little bit extra is just an annoyance. Mm-hmm.
Absolutely. Something else that we're expecting in 2025 is migration patterns changing a little bit.
Yeah,
and this is a big one.
This will be a big one.
Yeah, and I think we're going to be diving into that one tomorrow on the webinar. Yeah. So I hope you guys check it out. Jerry, if you could put the webinar link up again.
One of the real controversial ones is what Musk is going to do with all the government workers.
Yeah.
Working for a couple days.
So if you can go to and invest with MC, there should be a .com right there /Ken 2025, capital K, please. If you don't use a capital K, it's not going to work. Or you can just scan that QR code, will be easier. And we're going to dive into a bunch of fun topics tomorrow, and we're going to have some drinks because it's New Year's Eve.
Right. Bring your champagne, guys.
All right. I hope you guys had a nice holiday, and we'll see you tomorrow, hopefully.
Good seeing you guys.